Bank of America hasn't reported yet, but I mean, that's one where they've got a big advisory business. Wells Fargo's already reported. They're still losing advisors overall, but the productivity per an advisor is going up. So I think you'll see decent results for advisory fees in general across the board, just with assets having just grown. I mean, the wealth industry has been a good space to be in. And so I think for that, it's just that strength across the board in general.
How much will these banks struggle with rising wage pressures? We have now reported that Goldman Sachs is expected to have a special payout for its top 1% in the millions and multiples of millions of dollars, given the record performance. But at the same time, of course, there is that broader inflationary trend, not to mention that the competition for talent is really tough right now.
Yeah, and it's a great point, and I think something that people will be paying attention to. And like, for example, with JP Morgan's earnings, they broke out their expense increase into essentially two categories, and one of the categories they called structural increases. And by that, you can assume one of the major drivers of that was just wage increases driven by inflation. And so that was, they expect a 6% increase in that in 2022. And yeah, that's like, you put that in the backdrop of 6-7% overall inflation, wage inflation picking up. That's the type of number you didn't used to see. So yeah, I think definitely expect a pickup in expense increases driven by that wage inflation. You're already seeing that for JP Morgan. So that's definitely going to play out, I think, across the industry.
Eric Compton, the equity strategist at Morningstar, with his take on the bank's earnings season right now. Let's dig deeper into Wells Fargo, because it reported tepid loan growth in the fourth quarter, but said borrowing is likely to pick up as clients start to take on debt again and government stimulus wanes. CFO Mike Santomassimo told Bloomberg that consumers still have a lot of liquidity to grow the economy.
We did see in the quarter continued, progress in the recovery, and I think you saw that through the loan growth that we saw. And it was really across the board, both on the consumer side as well as the commercial side. On the consumer side, we saw growth in auto, in cards, underneath we saw some growth in our non-conforming mortgage portfolio as well. And so we finally started to see some of that growth materialize, which I think will be a good thing.
Give us a little bit more perspective there, because I did see that, if I'm reading the data correctly, that a lot of it was higher value of the loans themselves. Was the volume in loans also higher?
Yeah, we had a record origination quarter again, third quarter in a row in the auto business. Now, about 2/3 of our auto business is used cars. So we are benefiting from higher used car prices, but we're also seeing that volume be really strong there as well. The new car market's a little more constrained, but we're seeing that growth really come through in the used car volume, which is good given the mix of our business.
On one hand, you have inflation, which could impact consumer spending, and on the other hand, you have higher interest rates. And I'm wondering how much those higher interest rates could potentially stifle some of this loan growth and deter some of the consumers from taking on more loans.
Well, I think you have to first start with the fact that we're talking about raising rates means that we have a really strong, economy underneath it. And you see that, in spending, consumer spending, you see that in sort of the equity markets, you see that in, loan growth, as we sort of talked about. And coupled with that, consumers still have a lot of liquidity. It may be off the peaks that we saw, a couple of quarters ago, but still on average, maybe 30% more in consumer deposit accounts. So that really should help, consumers continue to be out there growing the economy. Now, rates, again, will be helpful for us, and we've talked about that in terms of our net interest income. But I think it's a good sign that, the economy continues to be pretty strong underneath it, which should be good as we look to the rest of the year.
Beyond the consumer business, you did show some strides in your investment banking business. I'm really curious, Mike, about specific plans to potentially grow that business more into this year and how competitive you think you could be.
Yeah, well, look, we think we have a lot of opportunity in the investment banking business, in particular as you sort of think about going after the opportunity to work with our middle market and commercial banking clients, where we have a really great market share, and we've talked about that opportunity for the last few quarters. So we think there's a lot of room for us to continue to grow. We're adding people both in the commercial bank in the investment bank, and that's in the context of us continuing to execute on our efficiency initiatives and agenda while we're still able to get costs down. We're able to make those investments to go after that opportunity, which we think will be significant over time.
And talk to us about those investments in getting that talent, adding those people where you want to expand. You're talking about $500 million in wages and benefits inflation. How are you having to compete for the right sort of talent right now, Mike?
Yeah, well, it's certainly a competitive market, and we've seen some wage inflation, and that $500 million is above and beyond kind of the normal increases we see in pay each year, and part of that is us increasing our minimum pay across the board to somewhere between $18 and $22, depending on where you are in the country, and we're really seeing that part of it have an impact on both recruiting and retention across that part, and we're going to continue to have to be competitive there, but we still think that we're able to do that. We've seen good ability to attract people to the platform. And again, that's still in the context of us being able to manage overall expenses down as we look at 2022.
That was Wells Fargo CFO Mike Santomassimo there speaking with us. You can also turn to Bloomberg for more on bank earnings. Of course, a lot going on this week. Go to TLIV Go. You can get commentary and analysis from Bloomberg's expert editors. This is Bloomberg.